This is one of the reasons that so many Americans, in fact, record numbers of Americans, are now working 2 and 3 jobs to make ends meet. According to the official statistics, this is the 15th consecutive month in a row where real wages are down. And they're down 3.6% now year over year. But that's if you adjust wages by the make-believe inflation number. But if you figure that inflation is 18%, not 9%, then real wages aren't down 3.6%, but 12.6%. You're seeing a collapse in real wages. That's why so many Americans need that second or third job to make ends meet, because these are unprecedented pay cuts, and they're going to continue. The high inflation is not just here for 1 year. It's here for multiple years, compounding. So this is going to be a dramatic reduction in real wages. But for a lot of American families, it's not just that wages are down, but they're working fewer hours. If you adjust for a decline in the average work week, average real household income is down by 4.4%, which of course means if you throw in another 9% to adjust for the phony CPI, we're looking at an actual decline of 13.4%. But what about the people that don't even have wages? What about the people who are living on fixed income? Their fixed incomes are being eviscerated by inflation.
We've had central banks here for now well over a decade doing nothing but inflate, creating cash out of thin air, buying assets with it. It was only a matter of time here before all of this money creation was going to present the current issues that we have. It's economics 101. It's all of these extra bills existing in either digital or physical form here, finally chasing the same amount of goods. You don't need to be a rocket scientist to figure this stuff out. And their own numbers are just all nonsense anyway. I think everyone realizes that, the data is all fake. It's interesting. We just recently found out, this is laughable. They're saying, what was this last week? I think it was reported that food inflation year over year is just up 10.4%. How many people are paying just 10.4% more for their food? I think it's more like, it's over 50, maybe in some cases 100% more. It's just more the deception, more the distraction, but this just is so simple to understand. The goal here of central banks is to foster in a new system, period, the end. And how they're doing this is by strangling people to death via surging inflation. That's why they continue to go out of their way to create more of it. The system is designed seriously to destroy an entire class of people, create more inflation, push wealth up to the 1%ers, and then a new system is going to be instituted.
Even if you ask central bankers, how is QE supposed to work? What is the theory behind this? They won't say money printing, because they know, you or I or no, we can't get our hands on bank reserves. We are not banks. We're not part of the banking system. So it's not like I can go into the grocery store and hand over a bunch of bank reserves and walk out with groceries. So they aren't even money on a technical level, on a real economy level. They're only for use in the banking channel. So if you actually ask a central banker, and if they're actually honest with you and say, well, how does this QE stuff supposed to work? They will never say it's money printing, because they know it's not. In fact, the very first quantitative easing in March of 2001, Bank of Japan, there was one sole dissenter. Her name was Aiko Shinotsuka. She said, why are we doing this quantitative easing? Because we don't know how to do quantity money. We can't define it. What we do is these bank reserves, and therefore we can't predict any correlation between the level of bank reserves and what happens in the real economy, because it's all sort of mushy. It's all psychology. So if you ask a central banker and they're honest with you, well, how is this QE stuff supposed to work? There's 3 theoretical channels. The first one is interest rate effect. And that's supposedly, the supply and demand. The Fed buys bonds, or the Bank of Japan buys bonds. And if the Bank of Japan or the Fed is buying government bonds, the interest rate's supposed to fall because there's more buyers for those bonds. And what you'll find out there is, no, it doesn't work that way either. Even the most charitable studies find a very negligible impact on interest rates, because the market is already buying those bonds, and though the central banks come in and buy after the market already has. So the market sets the interest rate and the Fed tries to take credit for it. So the interest rate channel doesn't really work. The second channel is portfolio effects. And portfolio effects is, as I said, QE is nothing more than an asset swap. So the central bank comes in and says, I'm going to pay you a little bit extra for that government bond you have in your portfolio. I'm going to give you bank reserves.
Same thing happened in the gold market. Gold, which was down about $15, ended up rallying to up close to $20 on the high before settling up about $10 at $17.36. Now, is that a sign that we've seen a top in the dollar and a bottom in gold? Probably not. It wasn't significant enough in my mind as a reversal. I think if the markets were really figuring this out, it would have been a much bigger rise in gold. It would have been a much bigger drop in the dollar. So the markets are still operating under the delusion that the Fed is going to win its fight against inflation. They still don't realize that inflation is going to win and that the Fed is going to surrender and instead try to fight to stimulate the economy. But this time it's not going to work. Remember, the only reason that monetary stimulus was able to work in the past is because the Fed was doing it when the official inflation rate was below 2%. And so they could get away with quantitative easing and 0% rates because inflation was still below target. They will not be able to get away with it when inflation is well above target because the bond market vigilantes will be back. The currency market vigilantes will be back. The gold market vigilantes will be back. The Federal Reserve will not get away with that type of monetary stimulus when we already have high inflation.
What people need to understand, at its core, the system, number one, as I said, is debt-based. It's a debt-based economic model. It must be fueled with more debt. It can't ever stop. Once we stop, we could end the system. We could, you see my hat back here in the Fed? We could end the Federal Reserve and every central bank in a nanosecond. If we just prevented them from issuing one single dollar of more debt, just $1, the entire system would implode. That's why they got to come up with reasons to continue to pull cash from the future and sell it to the public. I mean, we just heard from the World Bank. World Bank is saying that developed nations around the world must support impoverished nations or the global poverty issue is going to get worse. Well, I have a little clue for everyone who's listening to the global poverty issue is designed to get worse, much, much worse. And no amount of cash conjured up out of thin air being created by a central bank is going to fix the problem. The underlying issue is the debt-based economic model, and they will never let it go. And unfortunately, people are being lulled into this, and I think willingly in a lot of ways. People can't make it anymore. They can't survive, so they become slaves to the systems, which is the end game, which is the goal, the final solution to create slaves, to create a world of slaves.
I don't think people realize how much of the debt the Federal Reserve has owned basically throughout. I mean, you go back to something like 2003, 2004, people might be surprised to learn that the Fed owned 10% of the national debt before quantitative easing. They've always owned what they call earning assets because the Fed by mandate is supposed to fund its own activities. And the only way it can do that is by exchanging these bank reserves for actual assets in its portfolio. So the Fed has owned a lot of treasuries and MBS and other things for quite a long time. It only became an issue when we got to quantitative easing, and the proportion changed a little bit. I think it went from 10% to about 15, 16, 17% by around 2014 or so. But you're right, something was different in 2020 and 2021 when the Federal Reserve, the Federal Reserve did quantitative, but the federal government started to get involved directly in the economy through its helicopter drops, giving people directly cash, that it was borrowing from the treasury market, and some people say it was monetized by the Fed. And that's an argument that people can make. But I think by and large, what really happened was that the federal government borrowed from the treasury market, which was only too willing to buy safe and liquid assets. And so it didn't need the Fed to monetize that debt. The treasury market was going to buy whatever the federal government was going to sell. And so what you have isn't necessarily the creation of money or the monetization from the Fed as much as it is a redistribution on corporate commercial balance sheets, commercial bank balance sheets. So it wasn't necessarily money creation, but you're right, it was a way to circumvent, in one sense, the lack of willingness of the banking system to lend into the real economy. So it was a redistribution borrowed from the treasury market that the federal government then injected into the real economy, which had a temporary impact. It absolutely had a major impact on the global economy, but it was temporary. It wasn't a permanent shift in economic activity.